Alright guys, today I'm going to talk about credit and debt, but specifically credit cycles in the market. So as you all know from my previous video and blog post, I talked about savings and debt towards an individual. If you borrow more today, you gotta spend less tomorrow to pay off that debt, unless of course what you borrow is used to increase your income. Companies are no different. They borrow money for various reasons, but eventually they have to spend less than they earn in the future so that they can pay down their debts. Unless, of course, what they borrow to do and they put the money to work properly increases their sales, their profits, so that it could cancel out the debt in the future. Right now, we're seeing the Federal Reserve hike interest rates again. This week, Wednesday, actually they hiked interest rates by 25 basis points, which is 0.25%. And we're seeing a trend that the Federal Reserve of the United States will continue on this path of increasing interest rates. This shows that the credit cycle for the US is towards the end. And what happens towards the end of a credit cycle is that asset prices would start to fall. But this hasn't happened this year or recently, and I think that's mainly because of the fiscal policies by the US government. The trade talks, the tariffs, the tax cuts all help drive the market higher by providing not only available capital, which is more money into the system, but also a level of confidence in both investors and consumers for US stocks. So how should investors, react or respond to this environment? Well, if you're already in the market, you should meet with your financial advisor and make sure that your asset allocation, how your percentage of stocks and bonds is adequate for your risk tolerance and goals. If you are a new investor, then you should consider holding out, not investing too aggressively until towards the end of the credit cycle when asset prices start to fall, because that's the best time to buy when there's blood on the streets. For traders, it gets a little bit complicated because with technical analysis you get to know when. With fundamental analysis you get to know what's the most likely possible outcome. And the possible outcome for the US stock market is that we see, well, most analysts that I see and talk about, they see a slowdown in growth of both corporate earnings and mergers and acquisitions. So traders should go long in the short term, but keep an eye on a change in trends, because that's when they should go all in when the market goes down. I mean, all in as in shorting the market, not all in as in going long. But taking profit is also a good move. So I hope that this video brought some value, some information to you guys. And if you have any questions regarding investments, markets, or personal finance in particular, feel free to ask me. It's my major after all. Okay, and that's it. Thanks, guys.